Hello, everyone, and welcome to the webinar today. I am so thrilled that you could join us. We have a really exciting and informative presentation ahead of us. I do want to share my screen because I have some exciting news that I'd like to show you. We are actually amidst the launch of Rent Magazine. So I know a lot of you on the call subscribe to our Rent Magazine. We have on the cover this issue, Tom Wheelwright. He's the author of Tax-Free Wealth, and he's returning with a new financial bestseller, The Win-Win Wealth Strategy, which just came out last week on, I think a little over a week ago on the 12th of July, but we're featuring Tom today in the magazine. And also he's a speaker of our webinar today. So we're really thrilled to have him. I'm just gonna share a couple of things about him before we get started. And I hope that you'll all be able to tune in for the next 60 minutes or so. We'll have questions after the presentation, and maybe we'll stay a little over the 60 minutes, depending on how many questions you have. However, if you can't stay the whole time, that's okay, because we'll be sending you the recording and any sort of PowerPoint presentation that Tom is going to share tomorrow with you by email. So a little bit about Tom. Tom is a tax and wealth expert. He's the CPA and CEO of Wealthability, his own company, and he's a rich dad advisor, an entrepreneur, an international speaker, and author of The Win-Win Wealth Strategy, which is the book we're featuring in the magazine. And he's also previously the author of the bestseller, Tax-Free Wealth, How to Build Massive Wealth by Permanently Reducing Your Taxes. He is the CPA for Robert Kiyosaki, which I know a lot of you follow, and has spoken on stage on every continent to over 100,000 entrepreneurs, small business owners, and investors like you. He also is the host of two popular podcasts, The Wealthability Show with Tom Wheelwright and The Wealthability for CPAs show. So we're really happy to have you with us, Tom. You're such a qualified speaker on this topic, and we could really use a lot of advice always on lowering taxes or eliminating them in some cases. So thank you so much for coming on and talking to our group.
Thanks so much for having me. It is a delight to be with apartment owners in particular. I think apartment owners do a particularly great service in the world. So we'll talk a little bit more about that. I am curious, just by, if you just type in the chat, how many of you pay tax? Just put in tax if you pay tax. Go and put in the chat that just put tax in if you pay tax. See, I want to make sure I see everything. All right, go ahead and put in tax. You can either put it in the Q&A, put it in the chat, either one. All right, so now if you'd rather not pay tax, if you'd rather not pay tax, thank you. If you'd rather not pay tax, put in no tax. If you could choose not to pay tax legally, put in no tax. So this tax chat is disabled. Okay, so we're in the Q&A. That's all good. No tax, no tax, no tax. So I do want to especially thank Alexandra and the association for putting on this webinar and getting the word out on this. Really appreciate that. Really appreciate you taking time for being here today. For those of you who don't know me, maybe just a little bit of my background. I grew up in Salt Lake City, Utah. And as a good Mormon boy, at 19, I spent 2 years in France learning how to get rejected in French. And from there, I spent I had dogs also dogs. From there, I spent 2 years, a couple of years at the University of Utah to do my undergraduate in accounting, and another year or two at the University of Texas for my master's of professional accounting and tax. I spent 7 years with Ernst & Young, including 3 years in their national tax office in Washington, D.C. I spent 4 years as the in-house tax advisor for a Fortune 1000 company. 14 years as an adjunct professor at Arizona State University in their Masters of Tax program, 25 years buying, building, selling CPA firms, and the last 5 years spent the time actually building a network of CPA firms. We have around about 60 CPA firms around the US and in Canada, because as I travel the world with Robert Kiyosaki, the number one question I get is, how do I find somebody like you? So we decided, well, we're just going to have to teach people how to do what we do. So very excited today. One of the things that I get as we travel around the world, I always get this response, and somebody's going to come up to me. And I've had this literally in Santiago, Chile. I've had it in Kazakhstan. I've had it in China. I've been in Japan. Every time somebody's going to say, well, this is all great information, Tom. You realize you can't do it here, right? So for those of you who are in, for example, in California, which we sometimes call the People's Republic of California because of the tax laws there, or someplace other than, Texas, where there's no income tax. If we could just suspend disbelief for a little bit. I did write the book Tax-Free Wealth. It wasn't called Tax-Reduced Wealth. And we're going to talk about how to do it where you're located and how to actually permanently reduce or eliminate your tax and build a lot of wealth and do a lot of good in the world. So the first time I ever heard this was in Santiago, Chile. And the sponsor of the event, imagine this. So on one side of the stage is a Lamborghini, and on the other side is a Bentley. And because the sponsor of the event was the Lamborghini Bentley dealer in Santiago. I had about 600 people in the crowd. And Robert says to me the very first day, he says, I want you to teach them how to deduct a Bentley on their tax returns. And so I get up and I talk about, what the rules are and so forth. And at lunchtime, a tax attorney from Santiago comes up to me, and very reasonable guy. And he says, Tom, this is really good information. I'm sure you can do that in the US. You can't do that here. It's not legal to deduct your car, no matter what you use it for. I said, okay. So later that evening, I'm talking to Robert and a couple of the other Rich Dad advisors who were there. And I'm just telling the story about what happened. And Robert just goes, okay. Next morning, we're about to go on stage, and Robert turns to me and said, okay, today, I want you to show them how to legally deduct a Bentley in Chile. And I'm going, great, we'll just go with this. We'll see what happens. Later that day, Robert and I got up and we showed how to legally deduct a Bentley in Chile. And afterwards, the same tax attorney came up to me and he said, Tom, I never would have thought of doing it that way. I said, absolutely, that would work. That's fantastic. So in my new book, The Win-Win Wealth Strategy, in the last chapter, I actually show you not just how to deduct, but actually how to get the government to pay for a Ferrari. And it's a true story. I'll tell you a little bit about that later. But first, let's talk about why, how is it that you could deduct something that wouldn't otherwise be deductible. Why is it? And let's start with this idea of why is it that some people pay higher tax than others? So I'm going to share my screen here. I think. There we go. I'm going to share my screen here. And let's just talk a little bit about why is it that some people pay more tax than others. What happens is that really how much tax you pay depends largely on how you earn your income. So in Robert Kiyosaki's first book, Rich Dad, Poor Dad, which many of you I'm sure have read, he talks about the general principles of investing. But in his second book, Cash Flow Quadrant, he says, well, look, there's really only 4 ways that you can make any significant type of income. You can do it as an employee. You can do it as self-employed. You can do it as a big business owner, or you can do it as a professional investor, an inside investor. And as we traveled around the world, what's been really interesting, and really one of the reasons I wrote the book, The Win-Win Wealth Strategy, and looked at 15 different countries in this book, is it doesn't matter where you live. You're going to pay the same amount of tax depending on how you earn your income. So if you earn your income, if you earn a good salary as an employee, you're probably going to pay about 40% in tax. California, a little higher. If you're self-employed, you get to pay both your tax and the employer's tax. So now you get to pay 60%. If you're a big business owner, all of a sudden it drops to 20%, which is why, okay, now you see why Warren Buffett said famously that he pays less tax than a secretary. Well, his secretary's a high paid employee. He's a business owner. He's going to pay a lower tax rate. Professional investors can get down to zero. So let me give you an example. So in our last election, presidential election, we had, we'll call them three main characters. Okay. We had Joe Biden, who has always been an employee, typically for the government, and showed his tax return, paid somewhere in the neighborhood of 30 to 40%. Then we had Kamala Harris, who's an attorney and her husband's an attorney, and their tax return makes your jaw drop because they were closer to 60%. They pay a huge amount of tax. Then over here, love him or hate him, you had Mr. Trump, big business owner and investor, real estate investor. And New York Times in 2020 came out with this expose because apparently they somehow illegally got a hold of 15 years of his tax return, said 10 years out of 15, he paid zero, and 2 years he paid $750, which is accountant should be fired for the 2 years he paid $750. But nevertheless, why is this? Well, what happens is that we are all, like it or not, partners with the government. And the best way I can show you this is by showing you one of my favorite my favorite clips from a very old show. And I think Rachel here is absolutely the best at explaining this.
God, isn't this exciting? I earned this. I wiped tables for it. I steamed milk for it, and it was totally not worth it. Who's FICA? Why is he getting all my money?
So this is the question we all ask, right? The first time we get a paycheck, we all ask ourselves, who's FICA? Who's withholding? How come when I'm not getting all my money? Well, what we have to realize is that we are all partners with the government. Whether we like it or not, we are partners with the government. The question is, are we a silent partner? Are we a silent partner? Or are we an active partner? See, the government says, we don't care. We need tax money. We don't care really who pays it. What we care about is if you want to be a silent partner and you don't want to do anything special, you just want to earn money, spend it, save a little bit. Great. We're happy to have you pay 40 to 60%. On the other hand, if you're willing to do some things that the government really wants done and be an active partner with us, we'll have you pay less than that. So let's think about some things that the government wants done. Well, big business, what do they want? Big business, they want jobs and they want technology, right? Those are two very important goals of every government. All right, now let's look at the I quadrant, the investor quadrant. What do they want? Well, they want housing. They want energy. And they want food. So in my book, The Win-Win Wealth Strategy, I actually go over 7 categories where the government literally will pay you to invest. They'll pay you by lowering your taxes. That's how you pay. So if you ever wonder, why don't the wealthy pay a lot of tax and other people do? Well, this is why. Because the very simple rule, and you want to write this down, the more income I earn, the more tax I pay. the more wealth I build, the less tax I pay, which is really good news for you apartment owners. Okay. The more wealth I build, the less tax I pay. I'm going to show you exactly how that works, particularly in the housing industry. So housing, of course, being one of the key goals of the government, low-income housing, even workforce housing. Think about it this way. If you buy a house for yourself, you get a little bit of tax deduction, right? I mean, people own their own houses. And one of the reasons they own the house instead of renting it is they go, well, wait a minute, if I own it, I get a tax deduction for the interest. If I rent, I don't get a tax deduction for the rent. What if you own housing for other people? Well, now you get a much bigger tax deduction. I'm going to show you exactly how to maximize that tax deduction, particularly in multifamily. How do I maximize that tax deduction? By actually serving more people, right? Because the more housing you provide, the less taxes you pay. So the way I like to say this is the more good we do in the world, the less tax we pay, right? Anything that we spend or save is going to be taxable, but anything we invest the way the government wants to invested is not going to be taxable. So literally, I could earn $100,000 over here. I could take that $100,000 and put it over here, and I would pay zero tax on that $100,000. I would pay zero tax on that $100,000. So just think about that for a second. What if you have whatever income you have, whether it's from your business, whether it's from your salary, whether it's from a retirement account, whatever it is, what if you didn't have to pay tax? What would be the consequence to you if you didn't have to pay tax? And then the question is, what would the consequence be to the government? So interestingly enough, at least interesting to me, this is one of the reasons I wrote this book, is I found that the government makes more money from these people than it does from these people. It makes more money from those they incentivize than those they don't, because they're creating more income. Okay, by reinvesting, they're literally creating more income. They're not only doing good for things that the government wants, like housing, energy, food, jobs, technology, but they're also creating income for the government. And I find that fascinating because I was not expecting that when I went through and did this. But let's talk about, let's look at housing as an example, since that's where you guys are all in that space. Let's look at housing and how does housing get these benefits? So once again, I'm going to share my screen and we're going to talk about housing in particular and what can we do to maximize these tax benefits? Because I see it all the time. I've been, some people tell me based on my resume, I must be 105, but no, a lot of those things I did at the same time, right? But I have been a CPA for over 40 years. And I've seen a lot of people and I see a lot of tax returns from that I didn't prepare. And I see a lot of them in real estate because real estate is my personal specialty, is real estate taxation. I'm a real estate investor myself. And I wonder sometimes, how are these people paying tax? I mean, I'll literally see real estate professionals paying high taxes. I'm going, what is going on here? And I think it's just a lack of understanding how the tax law actually works. So take some notes, write in your questions, and we'll get to those questions eventually. But here's what I want you to look at. Okay, let's say that you buy a property, okay? And that property, you think about that property, all right, what does that property have? What's all involved in that property? Well, first of all, you've got the building, right? But second of all, you've got the land, right? Then you've got land improvements like the landscaping, you got a few trees in here, you got some landscaping and if you're in Arizona like I am, probably got some fruit trees. And then you've got the contents of the building. You probably got in here, you probably got a ceiling fan, right? At least in Arizona, California, you've got ceiling fans. And, you probably got some window coverings over here, right? And you probably got some kitchen cabinets over here, right? You got your cabinets. Okay, so those are the contents of the building. So basically what you do is you break it down and you go, okay, well, wait a minute. I have, so to summarize, I have the land, I have the building, I have the land improvements, and I have the contents of the building. Well, these things wear out. Well, except for the land, right? These things wear out. So then the question is how you get a deduction. How does the government give you a deduction for the wear and tear on your property? Well, it used to be that you really just got a small deduction, about 2.5% for the building. And that was pretty much what you were looking at. But in the early 1980s, starting in 1981, then again in 82, then 84, 86, we got 4 big tax bills. Ronald Reagan was president, and he thought that one of the ways to stimulate the economy was through lower taxes, and particularly lower taxes on real estate. First big real estate tax incentives were from the 1981 Tax Act. I'm old enough to remember that. So basically what we ended up with is land, we get 0% deduction. Building, if it's housing, because housing wears out faster than commercial, and it does, truly, we know that. We get about a 6% deduction every year, 3.6%, sorry. Land improvements, we get somewhere between a 7 and 10% deduction. And the contents, we get about a 20% deduction. Well, so because as a real estate investor, what we want most is we want our money. We don't just want our money, we want our money now, right? We want the more money we have, the more we can invest. The more money we have, the more money we can leverage, use debt and leverage that money, and the more real estate we can buy. That's how we create velocity in our portfolio. So obviously we'd rather have 20% or 10% than 3.6%. So what do? We hire somebody to come in and do what we call a cost segregation. And I'm always amazed by how CPAs react to this term cost segregation, because some of them will say, oh, that's aggressive. It's actually required by law. And once again, a cost segregation is technically required by law. Now, the IRS doesn't require it, okay, but they're not following the law. They're just saying, we're happy to take our money our money now and give it to and give you your deduction later if that's what you want. We won't hold you to this, but this is the law. Okay, so it's not aggressive. It's actually required. And you can do it at any time. You can do it when you buy the property. You can do it 5 years after you buy the property. So you don't have to do it when you buy the property, which is critical. Although right now you do want to do it when you buy the property. And I'll explain why. So a cost segregation, all you do is you have an engineer and they come in and they say, okay, here's how much when you paid for this property. If you paid $500,000 for this property, then, here's the portion that goes to contents. Let's say that's 20%. And here's goes to land, 10%, building, let's say it's 50%, and land improvements, 10%, and land, 20%. Those aren't accurate numbers, but they're not that far off. A typical cost segregation combination of your land improvements and contents is going to be somewhere between 20 and 30%. That is typical. Okay, but you can't use those numbers. You have to do a cost segregation. You have to hire a professional. Well, I want to be really clear on that. Okay, so that's great. It's great to get 7, 10%, 20%. But in 2017, we had a new tax law called the Tax Jobs and Cuts Act, or sometimes called the Trump tax bill. And shockingly enough, Donald Trump being a real estate developer, we got real estate tax benefits. And one of those was what we call bonus depreciation. Bonus depreciation, what I like to call is magic, because it is amazing what it does. Here's what happens. These two right here now are 100% deductible the first year. Now that is true only this year. It was true last year and the year before and the year before, but this is the last year, it's 100%. Next year it'll be 80%. And then you have to deduct the rest, the other 20% over the 15 years or the 5 years, whatever it may be. But this year it's still 100%. Well, what that means is, look at the math here. Let's go to our example. We have $500,000. Now, for most of us, we didn't come up with $500,000. That would be a mistake. Why would we come up with $500? Because guess what? We know that the bank is happy to come up with $400,000. That's our loan. And so our equity, right, is only $100,000. That's our equity. Well, here's what I love about the tax law. Banks don't get any benefit, tax benefit for the loan. Zero. You get all the benefit, which means that if you were to invest $100,000 and you did a cost segregation, and let's say 30% of it was held to be contents and land improvements, you would get a $30,000 deduction. But if you borrow $400,000 and buy $500,000 of property, now you get a $150,000 deduction, which is actually a greater deduction than the amount of money you put in. Top of that, let's say that you're in a 40% tax bracket. That means that the government is paying for 40% or $60,000 of this investment right up front. The government is literally, because you're using other money, right? You're not using your 100,000. You're using you're using $100,000 that was earned at some point. You got it from somewhere, and you would have paid tax on that. Now you're not going to pay tax on that, right? You get a tax benefit of $60,000. So not only do you not pay tax on the 100, but you get another $50,000 that you get a tax benefit from, and at 40%, that's $20,000. So you're getting all this, you're really getting all this money from the government. The government is subsidizing investors. The government is subsidizing investors. Now, here's something that I found interesting, and I've talked about this in chapter 4 of the Win-Win Wealth Strategy, is that the government is incentivizing debt. They don't just incentivize real estate, they incentivize debt. And you think about it, since 1971, when Nixon took us off the gold standard, money is now debt, and debt is money. So every time the bank creates a mortgage, it's actually putting money into the economy. So it's actually creating money. The government wants money created. Right now, they're slowing it down a little bit with the higher interest rates, but they still want to create money. And so they still give you this huge tax benefit for borrowing. They're not just giving you a tax benefit for buying the real estate or building the real estate. They're giving you a tax benefit for borrowing the money. So I want you to think about that just for a second. And if you have questions, go ahead and you can type in your questions right now, and just so that you connect with this, because now we're going to go a step further. Okay. So so go ahead, and if you got questions, go ahead and type them in. Here's what happens. Real estate isn't even the biggest tax benefit that the government offers. biggest tax benefit is always, and by the way, the best way to make money is always business. Okay, so business is number one. Number two is real estate. And number three, well, is agriculture, but I'm going to put down energy because not a lot of people do agriculture. But these are really kind of the top three. What is amazing is that real estate gets to use all three of these, because remember, real estate done right is a business and gets all the business tax benefits. Also, real estate, you can use the energy credits like solar, put solar on your real estate, and then you can use that. And so you can multiply your benefits. So not only are you getting the benefits from real estate, you're getting the benefits from business and energy. So I'm going to go to a couple of these questions because I think they're really good. So I'm going to go ahead and switch over here and answer a couple of questions just because I think it's a good time to look at some of these questions. So Patricia asked, if you've done 1031 exchanges and your basis is really low, then does the deduction only happen on new capital improvements? It also happens on when you buy a bigger property. So for example, let's say that you bought a property for $500,000, you sold it and you put $100,000 down. Now you sold it for $600,000. Okay, let's say you had an interest-only loan, so now you have $200,000. But with $200,000, I can buy $1 million property. I don't have to, I can do a 1031 into a $600,000 property, but I can also do a 1031 into $1 million property. If I do a 1031 to $1 million property, it means I'm taking on $400,000 more of debt. That $400,000, we can do the cost segregation and get the bonus depreciation on. Okay, we're not limited just because we did 1031 doesn't mean we can't do a cost segregation. So know that. Second of all, remember also that 1031s aren't always the best answer. Historically, they were. Prior to 2017, they absolutely were. Since the bonus depreciation came in, I would say at least 50% of the time, probably more, a 1031 is not the right answer. And let me explain why. So I'm because I think this is a little bit of magic, and I never see people do this. In fact, I see this mistake all the time. So let's say, let's take that same property. We've got a we've got a $500,000 property. We paid $500,000 for it. Now we're going to sell it for $600,000, and we have a $100,000 gain. But we've held it for a couple of years. So this is a long-term capital gain. And my maximum tax rate is 24%. That is my maximum federal tax rate. That includes the net investment income tax, which is also called the Medicare tax. And it also includes the highest long-term capital gain. That's the most I can pay in the highest bracket. All right. Now, let's say then I take, so now I've got 200,000. I go buy, so I would pay 24,000. Sorry, I would pay $24,000 of tax on that, right? Well, let's say I take that same 100,000. Okay, just the 100,000, not the original, just the gain, and I invest it. So I borrow another 400,000. And I buy another $500,000 property. Okay. I buy a $500,000 property. And let's say I get 20%. Let's just say I get a $100,000 deduction. You go, wait a minute. Okay, I've just offset my capital gain. I pay no tax. No, that's not what happens. That's not what happens. Because what happens is that $100,000 deduction is going to offset your other income. This is going to offset ordinary income. And ordinary income is taxed as high as 37%. So I'm going to get a $37,000 tax benefit. When I say tax benefit, and Lila asked, what do you mean by tax benefit? I'm talking about this is taxes you would otherwise have paid. This is taxes you would have otherwise paid on the money that you used to buy the investment, right? I mean, you had to get that money somewhere, unless it was a gift. You got it from your job or you got it from your business. Two places typically you would get it. Or you distribute it from your IRA. Okay, that's a whole nother discussion. But now what I've got is I've got a $37,000 tax benefit. And I've only got a $24,000 tax. So net, I'm ahead $13,000 because I did not do a 1031 exchange. I'm ahead $13,000. So 1031 exchange right now, it's not always the rule. It's not always the best thing to do, but always run the numbers. Okay, always run the numbers. Now, somebody who's decided to be anonymous, that's fine, said, where can I find info on the 100% bonus depreciation deductible this year and 80% next year? The IRC is the Internal Revenue Code. Okay, that's the law. Okay, and it's in section 168. Okay, if you really want to go there, my suggestion is find a CPA who understands real estate tax. Do not do this on your own. Huge mistake. Three most expensive words in the English language are do it yourself. Three most expensive words in the English language are do it yourself. The difference between a professional investor and amateur investor, professional investor realizes that investing is a team sport. I'm very adamant about that. I've invested in real estate by myself and I invested with a team, and it is way better and way more productive to invest with a team. So I highly recommend that. Now, here's Lila coming back. The account said that you cannot set off active income with passive income. That's true. So you have two choices. You can either change your with passive losses is really what I think you mean. So that $100,000, if I go back to my screen here. So this $100,000 deduction, this is normally called a passive loss. And a passive loss can only offset passive income. So we have two choices. One is we could change this from passive to active. The way we do that is either you or your spouse becomes a real estate professional under the tax rules. So you don't have to be a broker. You don't have to do any of that. You just have to meet the real estate professional rules. The other flip side is you could take this, your ordinary income, and you could convert it to passive. So your accountant is correct. You cannot offset passive losses against active income. But I would suggest asking a different question. And the question I would ask is not, can I deduct it, but how can I deduct it? So in other words, how could I deduct that $100,000 loss from my real estate against what is currently active income? And again, there are two choices. I can either become a real estate professional, so the passive loss becomes an active loss, or I can convert my active income to passive income. That would take me a lot longer than we have available right now, but I will tell you, I do it all day long. Okay, we have a network of 60 CPA firms. We do this all day long. So that is a correct statement. It is just, in my mind, it's not enough. Okay, so if you want to do this, I've almost never found a situation where you couldn't do this. Okay, almost never. So let me go into just one more thing here. because I want to go back into that whole idea of solar energy. Again, we have a window of opportunity. Most of you know that if you had put $100,000 of solar panels on your house, you would get, on your personal residence, you'd get a $26,000 credit, tax credit. That means that you'd literally, as long as you paid $26,000 in tax, you'd get $26,000 back from the government. You wouldn't have to pay that anymore. What most people don't know is that if you put this on your rental property, not only do you get a $26,000 tax credit, you also get an $87,000 deduction. So you still get that $26,000 credit, but you also get an $87,000 deduction. Well, if you're in a combined 50% rate, let's say you're in between state and federal, you're in a 50% rate, that $87,000 tax deduction is worth $43,500, which means that your total that the government's paying for is 26 plus 43, or they're paying for $69,500, and you're only paying $30,500. That's your cost basis into that solar panel. Well, let's say you borrowed 50%. Let's say you borrowed $50,000 to put on that solar panel. You're only paying $30,000, which means that you're going to put $20,000 in your pocket right off the bat. Now, let's say you don't borrow. Great. Now, what does that mean? That means that if your return on investment might have been 7%, now that's 7% on $100,000. And your return on investment, by the way, from solar comes from decreasing your utilities, right? So you need to be able to pass that on to your tenants, but you're decreasing your utility bill. But that 7% becomes around 22%. 22%, pretty much risk-free, unless you think you're just going to have horrible cloudy times in a sunny area like Southern California or Arizona, Florida, 25 other states. Unless you think you're going to have just no sunshine during the year, that 22%, that's a pretty reliable return on investment. A lot of people are just ignoring it. A lot of multifamily investors are ignoring this, and I think it's a big mistake. There are ways you can do a private utility, so that there are ways you can do it even on multifamily. So these are just some of the ways that you can seriously reduce your taxes through multifamily. And, one of the questions I get a lot on the cost segregation is, well, wait a minute, my accountant says that when I sell, I'm going to pay tax. Why? Why are you going to pay tax? I mean, you can either do a 1031 exchange, or you can just keep reinvesting. And then somebody says, well, what about when I want to cash out? I'm going, why would you ever want to cash out? Because what you have an opportunity to do, share my screen again, is, and I talk about this in my first book, Tax-Free Wealth. You start out, okay, so let's say you start out and you buy single family homes, right? Or duplexes, whatever. And then you decide, you know what? Don't like those anymore. I'm going to buy a couple of multifamilies, right? And I'm going to I do a 1031, or I use bonus depreciation. So I do 1031 exchange here, right? You use qualified intermediary, you use your CPA, don't do this by yourself. And then I'm even tired of that. So what I'm going to do is I'm going to go buy a Walgreens. And I'm going to trade these in on a Walgreens. I'm really going to sell them and then buy a Walgreens. And I'm going to do 1031 exchange or bonus depreciation. I can buy that Walgreens. Okay. And all during the time, I can either pull money out through debt by refinancing and debt, and debt's never taxable. okay, because you owe it back. So I can always pull money out, right? Or I'm constantly increasing my rents because it's going up in value. I'm a good investor. It's going up in value and I'm getting more and more rents. So now the rents, what we have now is we have basically, mailbox money, right? And I love mailbox money. This is my favorite kind of money. It just shows up in my account, right? I don't have to do anything. It's mailbox money. And then what happens is at the end, you go, okay, but I don't ever have to sell this, right? A Walgreens triple net lease. I don't have to sell that. So I can go from single family to multifamily to, I can 1031 any real estate for any real estate, as long as it's investment real estate. Then eventually what we have is we have the big D, we have death. And at death, all the tax goes away. All the tax goes away. It's called step up in basis. So, when I hear people say, my accountant said, well, this is just temporary and I'm going to have recapture and all this kind of stuff. I'm going, you need a new accountant. I'm sorry, but that's the answer. If I would tell you one more thing, if your accountant is afraid of the IRS, you really need another accountant. And I don't care if it's me, my group or somebody else's group, you need to find a CPA who specializes in real estate, who understands how to do the right entity structure, how to get a cost segregation done, how to do this so that you never pay tax. I do have clients, not all my clients, because they don't choose to do this, but I do have clients who pay zero tax. I have a client that's very public about, he makes $2-3 million a year and pays no tax. He was going to pay $1 million in tax one year. And then we talked and I said, this is a bad idea. Here's what you need to do. And he now pays zero tax. He's paid zero tax for the last 3 years. He chose to do, all I want to do is give you a choice, right? I just want to give you a choice. You can do this or not, but know that this is available. The whole reason for the win-win wealth strategy, 7 investments the government will pay you to make, is to let everybody know that we are all partners with the government. It is a bit of a game. The government is always going to win unless we cheat, and then they won't, but it's not a zero-sum game. It's a game where, yes, they make the rules, they enforce the rules, they judge the rules, and they can change the rules. It's also a game that while it's not a game where one player wins and the other loses. This is a game where both can win. Literally, the government can win, the taxpayer can win, and the public wins. And the public wins because now we have more housing, we have more jobs, we have more real estate. We have more commercial real estate, we have more technology. If you think about this, what would have happened over the last 2.5 years without Amazon? How would our lives have been different? If we hadn't had delivery services, what would happen? Well, that's all technology. That's all things that was government incentivized through tax benefits and really only happened because it would never have happened or would have happened a lot slower without the government incentives. Okay, if you look at Tesla and what they've done, Tesla and Amazon didn't pay tax for over 20 years. Well, why not? Because these are government incentives. The government is doing this on purpose. It's not a loophole. So again, if you've got questions, go ahead and type in your questions. Patricia asks, is the energy deduction per property? The energy deduction is a deduction per dollar. So basically you get a 26% credit and an 87% deduction. So it's not limited. All right. You can do as much as you want. On top of that, go back to the passive question. The solar tax credit is not passive. It is not subject to the passive activity rules. The deduction is, but the credit is not. So you can get the credit whether or not you're actively involved or it's or produces active income. All right, and we've got another question. Can we contact one of the CPAs in your network who work with us in the Los Angeles area? Yes, if you go to wealthability.com, we will actually get you set up. Now, we look at the right CPA for you. We don't look at, and if that's somebody local, that's great. we'll get you somebody local, but most of the time, it's not because they're local. It's because they specialize in what you want them specialized in. It's because they're an expert in what you need. And so, because I find that, I mean, I deal in all 50 states. We have clients in 30 countries. So tax is it's not that hard between states. It is a little more difficult as the government makes it more difficult, but we can absolutely set you up. So we're happy to do that. Win-win wealth strategy is easily, you can just get that at Barnes and Noble, or you can get it at your local bookstore. You can get it at on Amazon. Here's Joyce. She asks, is it worth putting an apartment I have owned for 30 years with zero basis left into a charitable remainder unit trust? Once in the charitable remainder unit trust, sell it and receive an annual distribution from charitable remainder unit trust. And the answer is it may be. If you don't want, now charitable remainder unit trust means that you don't, it's done, right? You're not passing this on to your heirs. The charity gets the remainder. You're getting the income. The charity gets the remainder. But that is a way to avoid capital gains. And in fact, now, interestingly enough, for whatever reason, it is on the IRS's dirty dozen list this year. And I don't understand that, but I think the IRS has kind of lost their minds. So I've never seen them like this before. Website. Hang on. Let me give you the website right here. It's Wealthability.
Yeah, for everyone, I put it in the chat. So I know you all are chatting a little bit here and there, but I did put the link in the chat. If you do have questions, it'd be probably easier if you put it in the question box now so we can keep track of those. Yes.
Here's an interesting question from Cher. She said, she says, I own 30 properties. I have a hard time getting a loan because my income doesn't show enough. This is where you need to be, there's a difference between the residential lending part of your bank and the commercial lending part. If you can get into the commercial lending, you're way better off. And the reason is because the commercial lending department is not going to rely solely on your tax return. They're going to look at your cash flow, and they're going to look at financial statements prepared by your CPA. So I would have your CPA prepare the financial statements, and I would go about it that way. I have clients who own hundreds and hundreds of single family homes and have hundreds of loans, but they go through commercial. They go through the commercial side. Mark asks, is it difficult to show yourself as an active real estate investor? It's not. It's two simple rules. You have to spend, you or your spouse have to spend more than 750 hours in real estate activities during the year, and more time in real estate than all your other business or job activities combined. So it really has to be your primary job, basically. And if it is, then you do, then you qualify. And by the way, let's say you've got Airbnbs. Those would qualify. They're real estate. Or let's say that you're a contractor. That qualifies. That's real estate. Now, there are other tests that you have to meet. That's the hard one to be, if you want to be treated as a professional, a real estate professional, that's what you have to do. And you do have to keep a log. Okay, you'd have to keep a log. All right. Let's see. All right. If you live in Florida but have property in California, you should have a California CPA. I would say no. You should have a CPA who understands California tax. That's what I would say. There are a lot of California CPAs don't understand California tax. I guarantee it. So you want a CPA who understands California tax. You want a CPA who understands multi-state tax. That's actually what I taught in the Masters of Tax program. So we spend quite a bit of time on the state taxes. Let's just run through a couple of these questions. How to get more information on converting active income to passive. I honestly, come to wealthability.com. I think it's simple. I have found that I'm the only one who talks about this, and I don't know why. It's just not that hard. Basically, it's a question of who owns your business. Right? Because you may be active in your business, but you might have your kids or a trust for your kids or your parents They may not be active in your business, and therefore they would be passive. They could also own your real estate, and therefore you have passive matching passive. That's a very simplistic answer. Please do not try to do this on your own, or please do not either try to do it on your own or try to do it with a CPA who doesn't understand how to do it. Okay, you do need a team of people. Lisa, is there a network of good commercial lenders? I am sure. That is a great question for Alexandra. I will let her deal with that. We have a lender who suggests getting a personal mortgage and turning the property over to your LLC. Now, when we do tax planning, we always look at 4 areas. Okay. The first is, what's your wealth strategy? We need to know, what are you going to do with your money? How do you want to invest? How often do you want to invest? How much do you want to invest? That's your number one question. It is not tax. Don't let the tax tail wag the dog. And so you go to, so you want to know what your wealth strategy is. You want to develop a wealth strategy. Make sure you're really clear. What are your criteria for investing? How much are you going to invest? When are you going to invest? What kind of loans are you going to get? How much, what kind of cap rate are you looking for? What kind of cash flow are you looking for? All of those things. Okay. You want to be really clear on your wealth strategy. Second of all, your tax strategy. Okay. But now you get 2 more things that most people never look at. I will say most people never look at a wealth strategy, but they definitely don't look at asset protection strategies, because asset protection, the more wealth you build, the bigger target you are. So you definitely need to protect your assets. And the fourth one is legacy planning. What are you going to do when you die? Who gets your wealth, and how do you want them to get it? All those 4 things need to be looked at the same time. Don't look at them independently. Please. This is where a CPA can be a great coach and a mentor for you, because a good CPA will look at all 4 of those. When we do our planning, we start with the wealth strategy. Okay. We actually have software that helps you through the wealth strategy, but we start with the wealth strategy, move to the tax strategy, then, and the asset protection and the legacy plan. We want to do all of that. Lucia asks, if real estate's owned by a trust, is there a different rule? It depends on the type of trust. If it is a living trust, then that is ignored for tax purposes. If it is an asset protection trust, like it's a trust for your kids or your trust for your elderly parents, whatever, that is it. There, it's an asset protection trust should be its own taxpayer. So then you can do this. Okay. Thank you, Lisa. You're welcome, Lisa. All right. This is the questions. We've got the questions, Alexandra. I can go for days on this, just know. I can go for days on this, but this might be a good place to stop here.
Well, I am going to issue out this poll because it seems like some of you might be interested in talking to Tom's team or just finding out, I guess, an initial call if you are actually paying too much tax. So if you say yes to that, I'll share info with Tom to make it a little easier for you guys to connect. And also, Tom, if you want to stay for a few more minutes, if you see any other good questions, I don't think we would mind extending this a little beyond the 60-minute point, unless you got to go.
Yeah, no, absolutely. If people have questions, go ahead and ask your questions. I'll stick around for a few minutes. We do actually have a tool and we do this. We don't charge for this, looking out to find out if you're paying too much tax. We do have a tool. We only accept about 20% of the people who apply to work with us. Okay, we turn down 80%. And the reason is not because you're not making enough money. It's not because of anything else. It's because we don't think we can help you the way we need to help you. So we're only going to take on clients that we think, it's a really good fit for you and for us. And we think we can really do a good job with you. And that's why we always look at, okay, are you paying too much tax? If you're paying too much tax, we'll let you know. We won't be able to tell you exactly how much you're paying too much tax. That's what the whole strategy is for, is to figure out how to pay a lot less tax or zero tax even. But definitely if you feel like, or even if you don't know if you're paying too much tax, you say, just find out, get a second opinion, no charge. Okay, we're happy to do that. So thank you.
All right, great. So another thing, while you take a look at the questions, I just want to share with you all on the call here my screen one more time. Let me make sure I got the right screen up. I wanted to share with you our website, because I know somebody asked about like an investor network or resources, and we have a lot of them. So let me go ahead and just share that real quick here. So if you go to our site, aaoa.com, and then you go to real estate, I could put this in the follow-up email for you all as well as any links we mentioned today. But essentially, if you're looking for an agent or broker, we have a way for you to search for one here. Also, if you are looking for off-market properties that are exclusive to AAOA, these are AAOA member properties that are currently on the market. Some of them, as you can see, are exclusive. And if you want your property on here, we can put you on here for free. So we'd be happy to market your property, and we send this out to our network of investors to let them know of like new opportunities. And then we also have a page for financing if you're looking for a loan for different purposes. You can see here, purchase, refinance, construction of any amount. We can connect you with a broker in our network. 1031 exchange, what Tom mentioned, may not always be the best, but if it is, this would be a great place for you to see the different providers that we recommend. And of course, insurance, which is a great way to couple that with your, LLC and make sure that you're covered. So just letting you know that this is a new page on our site. So definitely take a look at it and use it, and call us if you need a recommendation for anything as well.
What a great resource, Alexandra. That's fantastic. I love the financing, the 1031. So know that on 1031, you have to use a qualified intermediary and they have to be perfect. Okay. They can't even make one mistake. So you do have, absolutely, to have referrals like this. I think that is amazing, Alexandra. Thank you so much. That's
Great.
fantastic. What a great resource. Cher was asking, I want you to look at my taxes. You haven't filed 2021. That's okay. We'll look at 2020. Okay. That's okay. I get it. I mean, you guys with all these properties, you probably haven't filed your tax return yet. We're in the height of our busy season right now in my CPA firm. So happy to get with you, happy to find out if there's some way we can serve you.
Great. Well, if there were any questions that weren't answered, Tom, I'm going to follow. I could just send them to you if you want.
Yeah, for sure. Let's see. Hang on. Oh, can I answer just one here?
Yes, please don't take that as a conclusion.
Okay.
Answer as many as you would like. Just hoping people don't get disappointed if we don't answer them all.
I'm actually going to address a couple of these.
Okay.
Paul asks, what are your personal thoughts about a DST, which is a Delaware statutory trust? And this is a way, basically we used to do TICs. Now we do Delaware statutory trusts. It's the same thing. Basically, a DST, a TIC is a tenancy in common, right? So you have an undivided interest. A Delaware statutory trust is effectively the same as a TIC, but it comes with an agreement between you. It's just easier to administer. The only reason that you use a DST is if you have multiple investors in the same property, and some of you might want to do 1031 and some might not. If you're going to sell the property in the end, an LLC or limited partnership works just as well. But if you do have, if you're going, well, I'd like to be able to do a 1031, then that's where a DST comes into play. Now, WC says, can you tell me your thoughts on a 401k, using 401k for real estate? It's a terrible idea. I'm going to tell you right now, it's a terrible idea. And I'm going to show you real quick why. It's really simple, but it is a terrible idea. And we all learned this. Here's something we all learned when we were in grade school. -1 times -1 equals +1. Well, you have real estate, which is a tax shelter. It's the best tax shelter. Like I said, it's one of the best tax shelters we've got. You put it into a 401k. which is also a tax shelter. And what you end up with is paying tax. And you end up paying tax on your real estate. It's a terrible idea. Second of all, you typically cannot finance in a 401k like you can outside of a 401k. So the only time when it's okay is let's say you've got a pension plan or something like that, and you're investing in syndications, right? You're buying into syndication, might be okay, right? I will tell you though, real estate tax people hate using, as a general rule, we don't like using retirement plans for real estate. There's just too many downsides to it and not a whole lot of upsides. So, and here's the other thing. People will say, well, wait a minute, but if I pull the money out of my 401k, I have to pay tax on it. Well, yeah, you're going to have to pay tax on it when you pull it out eventually. What's the difference? If you're never going to pay tax, and it may be less tax now than it would be in the future because you're going to grow that. Let's say you grow that inside your 401k. Now, when you pull it out, you're paying a much higher tax rate and you're paying a lot more tax. So really all you're paying, the only extra you're paying is the penalty, the 10% penalty. And I will tell you, with bonus depreciation, frequently your bonus depreciation will more than offset both the tax and the penalty from your 401k, as long as, again, you can either be a real estate professional or, offset, turn some of your ordinary income into passive income. So you have to meet those tests. But I've had a number of times when I've had a client who pulled their money out of the 401k and actually paid less tax than if they'd left it in the 401k because they invested in real estate. So it's just general rule. Don't use retirement plans are really good for trading stocks, investing in stocks, gold and silver. That's what retirement plans are good for. They are not very good for real estate. They don't work at all for business. Okay, period. There's been court case after court case after court case saying you can't do that. All right. And they just don't, and they just don't make sense for real estate because you can't leverage as much. Okay. You can never leverage as much because it's got to be a non-recourse loan, right? So you can't do a recourse loan inside a 401k. It's not allowed. It's called a prohibited transaction. So you can't do a recourse loan. You can only do a non-recourse loan. And because you can do a non-recourse loan, typically the loan to value is not going to be as much. So debt is what makes real estate magic. Okay. That's what makes real estate magic. It's not real estate itself. It's debt. That is what compounds your returns. It's what compounds your tax benefits. And I will say one more thing about debt. Because there are people out there, we won't mention names, that don't like debt, even on real estate. And I would say that if you're afraid of the debt on the real estate, it's because you don't trust the real estate, period. If you're afraid of debt on the real estate, it's because you don't trust the real estate. You're not confident enough that in a bad time, in a downturn, you're going to be able to pay off your debt. And that's why you don't use debt. And that's the only reason to not use debt. And I will tell you, the most popular guy on earth who talks about not using debt, that's why he doesn't use debt, because he got caught with his pants down, used debt wrong time in the wrong way on real estate. And so now he preaches to the world, don't use debt for real estate. I would tell you that you're missing out on probably 3/4 of your financial benefits and probably 80% of your tax benefits by not using debt. So I'm a big fan of debt, but I trust my real estate. Okay. So I trust my asset. Like if I were to go out and buy a CPA firm, I'd never put money into it. I'd always borrow the whole thing because I know how to run a CPA firm. Okay. I trust the asset so much. Why would I care about the debt? Mm-hmm. Same thing with real estate. If you trust the asset, you don't have to be afraid of the debt.
I think that's really sound advice, especially when it comes to the fear or the paralysis when you come to think about adding another property to your portfolio. And going through the numbers, leaving a margin of error for downturns, it should always work out if you do it the right way. There's no guarantee in anything, of course, but you're right. It does come down to trust. I like that message a lot. Thank you.
Absolutely. And I think we've covered all of these questions. I
Wonderful.
think we're good here.
Wow.
Well, thank you, everyone. This was great. Questions were terrific. Absolutely terrific questions. Thank you. I love answering tax questions, but I'm very much a tax geek. So I love that. And I really appreciate the support of AAOA, particularly for, my new book, The Win-Win Wealth Strategy, 7 Investments Government Will Pay You to Make. If you're a little concerned about debt, if you're a little concerned about your next project or whatever, read chapter 4 of the book. And chapter 4 of the book is about real estate, and then read chapter 2 because that's business, and then read chapter 5 because that's energy, because you're going to want to combine all of those, and then read chapter 9 because what you're going to want is the last chapter, which is how to get the government to pay for your Ferrari. So every real estate I know wants a nice car. So here you go. Let's get the government to pay for it.
I love it. Okay, well, everyone, don't worry if you didn't write down all those links. I'm going to send them to you tomorrow via email with the full recording, Tom's information, Tom's new book, the magazine where we're featuring Tom, all of the AAOA's new real estate resources. And we're so happy that you were able to make it to the webinar. And I hope that you'll come to the next one. Next week, we're doing a California specific one on the new balcony law. Yay, another California law. California is requiring apartment owners to get their balconies inspected by 2025. And that is a rule now. So get your inspections ready. We're going to have an engineer come on and talk to you about them next week. So not the most fun webinar, but definitely one we need to hear. So I'll be in touch with that as well. And thank you, Tom, so much for your time. I really appreciate it. I hope that we'll have you back again soon. And you'll be hearing from Tom, I'm sure. I'll send you his info if you did opt in for any sort of consult or anything like that. Thank you again.
Thank you.
Take care. Bye.